On today's episode, we're diving into the world of agency buyers, who they are, why they buy, and how their motivations shape the kind of deals they pursue. We'll also talk about what makes Barrel Holdings different and how we think about acquisitions for the long term.
All right, Sei-Wook. So I think a good way to start this episode is first by mapping out the landscape of agency buyers. So not all agency buyers are looking for the same thing. They all have different visions for, what an acquisition can do for them. And so, yeah, maybe we'll cover the kind of major types that we come across often, and then we can kind of dive into what makes each of these buyers unique. So you're going to kick off with the first one?
Let's see, the first category is we'll call it individual buyers. So these are typically people that are first-time acquirers or operators that are trying to buy a business instead of building it from the ground up. There could be different motivations for this kind of buyer, right? Sometimes if this is the first business they're getting into, maybe they're dipping in their toe into business ownership and want to buy a business to kick things off. And some people might want the independence of running their own shop versus being part of something else. Or, yeah, maybe it's the cash flow that's appealing about these agency businesses that, people are interested in.
Yeah. And typically we kind of often talk about some of these buyers are in many instances buying a job. I think,
Yeah.
it might be somebody who worked in the corporate environment for many, many years. And then, they got sick of, the bureaucracy of it. Maybe they wanted something where they had more control, autonomy over their time and the activities they do every day. These are the types of buyers who might look at other businesses as well. And then they might find that, oh, okay, the agency business is something I want to get into. Yeah. Maybe we could talk about like how they typically finance a purchase like this.
Mm-hmm. It's typically heavy on the debt. So using SBA 7A loans as a typical vehicle for financing this, with a combination of seller financing, where the seller of the business is providing essentially a loan to the buyer. And then along with that, it's putting up some initial seed kind of capital or equity, along with, personally guaranteeing the loans that are given through the SBA.
Yeah. And typically on these, like they're pretty highly leveraged. It's like, oftentimes it's kind of like buying a house. They're putting down maybe 10% on top of that. Yeah. Borrowing the 90%. There's definitely risk here, but then, if they find the right kind of business and, it's cash flowing well, could cover the debt service, pay the owner a salary. And if they're able to grow this, then what is the kind of upside they might see?
Yeah, I think to your point, it's the baseline is, can they service their debt, buying themselves into a job? So can they operate the business, and can they grow their equity through paying down the debt of the business? And also, yeah, the future could be just holding this ongoing and using it for continuous cash flow, and maybe eventually hiring more people to operate the business so that they can take one step out. Or in 5, 6, 7 years, they could put the business back on the market and sell it at a increased multiple if they've kind of grown the business through operating it in a better way.
Yeah, definitely.
Yeah.
Let's talk briefly about what happens to somebody who sells the business in this way. So let's say you're an agency owner and you end up selling to an individual buyer. So as the seller, what typically happens?
In this case, you're typically trying to replace the founder or the seller of the business. So usually it's 100% buyout, where you're getting either cash upfront or through that seller note that we mentioned. And the seller is usually staying on, call it like 3 to 6 months to help with that transition. And that's, helping explain things in the business, transition relationships. But ultimately, the seller typically wants out and wants to exit from the business.
Individual buyers, definitely you could say it's you're still playing in that small business world. And so maybe a good way to kind of transition this is to talk about a big contrast, which is the second type of buyer we want to talk about, which is the strategic buyer. And, the word strategic buyer, it is what it sounds like. The buyer is buying an agency for strategic reasons. So it's not to just add dollar amounts. They actually think it's a 1 + 1 = 3 situation, where they think, hey, if we're able to acquire this agency, it's going to make our business that much more valuable. And so typically strategics are often sought out as the best kind of acquirers from a financial sense because they're willing to pay higher multiples. And usually, this might be another agency that's bigger, or maybe even a network. You talk about the big public holdcos like WPP, Publicis, those guys. A lot of times it's about expanding capabilities, geography, maybe even getting into different verticals. And, I think synergy is like the big word here because, they see a lot of cross-selling potential. It's like, hey, if we bought, for example, if you're WPP and you're like, hey, we need this influencer agency and we really just need one because if we can get this agency into the mix, we can get the huge, global brands to buy this service and, bring all this new client revenue in. And so we're willing to pay a huge multiple for that. And so, yeah, I think this is like why typically, if you're an agency that, has caught the eye of a strategic buyer, they have big plans for you.
Yeah, for these, like to your point on integration, it's all about like that expansion under that parent brand. So if it is a bigger agency that you're folding under, essentially in this model, your agency typically just you lose your brand, you become almost like a department or division of a larger entity, but you get access to all of their systems, their clients, everything that they've kind of built up to that point. They see like a multiple option where, they buy you at a certain multiple, your business could be smaller, but once you integrate it into the bigger pie, it now trades at a higher multiple because it's part of the bigger umbrella.
Yeah, let's get a little bit more specific about that. Can you give an example? Like, yeah, like what would that mean? So let's say an agency, yeah, maybe just walk through like a number
Yeah.
example. Yeah.
Let's say an agency that does sub million in EBITDA might sell for, say, 2 to 4x of their EBITDA when they're getting acquired by a strategic, for example. But the strategic might already have 10 plus million in EBITDA, which, if they were to sell, that would trade at 8 to 10 times in terms of the multiple. So from the strategic standpoint, they're buying you at a lower multiple. Once they integrate you into and it's all combined and integrated, it's suddenly the value of your EBITDA has multiplied immediately after integration.
Yeah. So, I mean, that's
Yeah.
definitely like part of the acquirer's playbook is that multiple expansion they might get. But, we talked a little bit about the process of integration. What are some risks that might happen in a strategic acquisition?
Yeah. It's because you're integrating, like your brand gets diluted and, any brand equity that you had could, disappear and the value of that could disappear in this integration. The team that's used to working in one way with their own processes, there could be I'll call it like a cultural mismatch with a bigger company. There could be a lot more rigid processes, how they do things, the roles, the titles, everything could be different. So that could cause some friction. And yeah, not all of these integration stories go, perfectly. Sometimes, people buy with the intention of combining and having, one division or people integrated through other parts of the organization. But, other times it just doesn't work out that way.
Yeah, definitely. If it's a larger agency absorbing a smaller agency, a lot of times, yeah, the brand does go away. I think in some instances of networks, sometimes the agencies do retain for a long time or maybe even indefinitely their brand, but on the back end side of things, like so many things might change. Like you might, even small things, which are actually kind of big, like you might go from being a Google Suite, like Work Suite kind of agency to now you have to adopt Microsoft Teams everywhere. That's a shift, right? And then other kinds of things, you might move from your cool office in, Soho, like a Loftus Soho office to now you got to work in the FiDi in like a super corporate space. So there's a lot of like cultural changes that could happen, which, then could lead to people leaving the company and just becoming a totally different type of business. And maybe just on the the seller side of things. So in a strategic acquisition, maybe you could talk about, how are these typically structured? Maybe in a way that's different than the individual buyer buying a business like this. And like what are some pros and cons of this kind of transaction?
Yeah. So a founder in this type typically, earns some cash up front in the deal, but a lot of the value is tied to an earnout, meaning they have some performance targets they need to hit over 1 to 3 years, typically. So the founders is incentivized to stay on and make sure the integration goes well, they hit their numbers and they continue to grow. And when that happens, the founders essentially joining the parent company in some sort of leadership role. But yeah, they're now going from being the founder, leader, CEO to a team member as part of a larger organization.
Yeah. And I've seen like such a wide range of folks and how like an acquisition to strategic have gone. So some have actually thrived under the buyer and, kind of risen to leadership roles within that, whether it's a network or a bigger agency. Others like this, immediate mismatch and maybe they don't even stay for the earnout and they're gone, within the year. So yeah, you see a huge range of outcomes.
The pros and cons of the payout and the number can be high, but the integration is not as simple. Yeah, let's think about the next category, and this is private equity backed platforms. So this is usually, private equity firms, so kind of financial investors trying to build a platform. So platform meaning an agency that can serve as the baseline to have bolt-on acquisitions where you do acquire smaller agencies, whether they have complementary services or adjacent services, so that the kind of the platform gets kind of larger and can increase scale.
Yeah, I mean, roll-ups are another word for some of these things. And platform usually starts with that kind of anchor agency that, has some scale already. Typically, I mean, at the low end, 3 million, but it could be, $5, $10 million EBITDA agency that starts as the anchor. And then top of that, yeah, more acquisition. I mean, there's organic growth to it, obviously, that's being invested by the PE firm to grow the agency, but then also, yeah, smaller acquisitions. And then this is what, we talked about previously. The multiple expansion is actually probably even more important here just because there's a bit more of that financial engineering going on where, hey, let's do a ton of these bolt-ons or tuck-ins because every time you add one in, you're basically, if you get a lower multiple, you're basically getting a great discount on it, on the purchase by getting that multiple expansion. So I think that's a big part. But then there's other aspects to it. Maybe you could talk a little bit about, yeah, like sometimes private equity folks love talking about playbooks. Maybe we could talk a little bit about that.
Yeah, private equity firms typically have operating partners who done this before, worked in agencies or similar businesses. So they'll come in and look at your ops, look at your costs, and private equity has kind of a negative reputation for coming in and slashing costs, but not all are done in the exact same way. But there's essentially trying to figure out how to make the business more valuable through increasing EBITDA and also looking at ways to scale either organic or inorganically. But I think the big thing to understand about private equity is in their business, their job is to acquire, grow, and sell within a 3 to 7 year time horizon. So their intent is to grow value and sell. And I think that's an important distinction here.
Yeah. And three's probably on the super aggressive side. It's probably more normal, like 5+ years it'll take. But yeah, but definitely that is a huge difference is that they're attached to a fund. So private equity firms, they raise a fund where it's typically over a course of 10 to 12 years, they got to deploy that capital. Let's say they raise, I don't know, 100 million, $1 billion or whatever. They got to invest that capital the first 5 years. And then the next 5 years, they have to harvest on those investments by exiting these companies and then return a capital to the investors. So definitely like with those dynamics, you really got to think about, yeah, how do these things play out? And maybe you could talk a little bit about like, yeah, what's the seller experience here? If you're an agency owner selling to private equity, what can you expect?
Yeah. In this instance, because there is that exit, the second exit on the horizon, a seller might take, sell partial liquidity. So that they might sell 60, 80% of their business and roll the remaining 20 to 40% of equity into the platform so that when there is that next exit, they can get a second bite of the apple and realize a higher multiple on that remaining amount.
Yeah. So
Yeah.
basically, I mean, just simple math, right? You sell your agency for 10 million, you might get 6 million at close, but then let's say 40%, 4 million, you roll into the platform, but then later you realize a 10x on that 4 million. I mean, let's just say the big numbers here. So you could actually have like 6 million from the initial thing. And then if you hit a home run with the second bite, that could be another 40 million or whatever, right? It's probably,
Yeah.
you think, but let's say even at like five, let's say even at like 4 or 5x, it's like, yeah,
Yeah.
that second bite could be quite significant.
Yeah. So in this instance, the seller is also incentivized to stay on in the business for the additional, 5 to 7 years until that next exit to make sure that everything integrates well, scales well, and they can maximize that second bite that they get.
Yeah. So, like you mentioned, private equity, I think historically has a bad rep, but then, one of the things that we hear a lot from private equity folks is like value creation because, yeah, like they are really building these businesses up to be more valuable for the next buyer. And usually that next buyer could be another private equity, a bigger private equity firm, or it could be a strategic buyer. So they might actually be, able to sell this into, let's say, one of the networks or an even bigger agency backed by an even bigger private equity firm. So like a lot of this stuff, they kind of end up intertwining over time. So we're going to go to the next one, which is the independent holdcos. So these are, what we call kind of permanent capital buyers. I think something that we're aspiring to build here at Barrel Holdings. And these are like either founder or operator led groups that, are looking to buy and hold agencies for the long term, sometimes indefinitely. And I think the motivation here, and we talk about this a lot in our models as well, is this compounding value over decades, where you're able to preserve some culture, align incentives, and then, have this really decentralized kind of management structure with maybe some share systems, but ultimately you're taking the cash that's coming out of these businesses and then reinvesting that capital with a degree of discipline. And how these vary from the private equity firms or funds is like there's no fund at all, no timeline, and then so there's no kind of this limited partner investor pressure to exit the agency businesses and return capital. So there's a definitely like a different kind of time horizon to these things. And so what happens when agency owner sells to a holdco, an independent holdco?
I think there's probably the most flexibility here on how the founder can stay involved, either through, if the founder wants to sell their full stake and get out of the business, that's definitely an option. But there can be a longer term earnout where they're kind of involved in helping make sure there's a smooth transition and finding a second in command or a new CEO to run the business. They could, stay longer term if they want to be an advisor, and you can orchestrate it where they get some additional profit distributions or even phantom equity in the case. So isn't a requirement, but the agencies could sell in 10, 20 years, down the road. And if that founder wants to, roll some equity to get some upside further down the line, that's a possibility too. But here I would say it has the most flexibility because there's no fund, there's no investors, there's nothing that forces actions in one way or another.
To that point, I think the option there are some holding companies that also issue equity at the holding company level. So this is like there's some value at the aggregate, like all the businesses, the portfolio. And so, there are instances, I mean, we don't do this at Bear Holdings today, but you could have a situation where an agency owner sells their agency to a holdco, and then they're also, in addition to getting paid out, they might get some stock in the holding company. And so now, and maybe that holding company, at some point might go public. Maybe there's some private stock sales, share buybacks every few years. So there are mechanisms like that in which they're able to realize some value of the aggregate going up and partake in that upside.
Yeah, that's right. There are whole companies that do raise money at the holdco level to do more acquisitions and all that. So yeah.
But I think you're absolutely right about like the long term focus because like the investors have a different kind of expectation. So they might be like, oh, you know what? Like we're in it for the long term. We're okay with this kind of like 20-year outlook on this investment, and then they might get distributions along the way, which kind of satisfy their requirements as investment.
Yeah. So I think when a holdco buys your company, I think it's really thinking about how do you retain that legacy of the business, have it operate for multi decades potentially, and then have that culture kind of intact as you continue to scale.
Yeah. Yeah. Speaking of which, the
Awesome.
next one. Yeah.
Yeah, so the next one is management buyouts. So this is a case where people within the business, so either the leaders or partners within the agency, end up purchasing ownership from the founder of the business. And this is, if the founder wants to get some liquidity, so they want to exit their business, but have some continuity for the the business that's there already, same leadership team, but also it's a way to incentivize that team long term to take ownership and have ongoing value from that business.
Yeah, I've seen this play out, especially with like multi-generational type of businesses as well, where, might be, the founder might have their own children kind of in the business who are, doing a buyout, but also they might have nurtured some, proteges along the way who have risen to be leaders in the business. And, one way for the owner to kind of, maintain the legacy, but then also provide the next generation with an opportunity to, take this business on. The management buyout is a common mechanism for that.
Yeah, and in this case, there's less of a big upfront payment in terms of for the founder. It's more of like a gradual payment structure through seller notes, maybe some personal financing from the leadership team. In some cases, maybe pulling in some outside investors to buy out the owner. But it's definitely a kind of a slower but stable way to kind of transfer the ownership of the business.
Yeah. I
Yeah.
mean, I've heard of some cases where you might borrow, so the management might borrow some dollars from a bank, for example, to kind of make that initial payment. But you're right. There's definitely a flexibility of like the seller note might carry the bigger load on here.
Yeah. And in this case, which is different than the other ones, there's no like financial backer, there's no HoldCo, there's no like big outside party that could invest in growth per se. So like, let's say you want to do more M&A and buy other companies, or you want to invest in different capabilities. In this case, it's more kind of, I'll call it like business as usual versus like, hey, like we're going to shake things up and insert a bunch of cash to grow the
Yeah.
business.
Although,
Yeah.
one of the things that I think, we have seen is like younger generation comes in, takes over for the founder, and then they have different energy and goals.
Yeah,
And,
definitely. Yeah.
and then,
Hmm.
they can maybe invest a little bit more in growth and, really aim for maybe a bigger exit for themselves. So like, I don't, I think, so many things can happen where, the owner might have just taken a, hey, like I want my management team to buy me out, but then maybe the next generation sees a different kind of opportunity and pursues that, and either finds a strategic buyer ultimately, or maybe even sells to private equity. Okay, so we have one more we'd like to get into, which is the less common, but it still is an option, is this employee ownership. So this is a bit different than the management buyout, and these are kind of the best categorized as ESOPs, employee stock ownership plans. And so these are situations where the agency itself becomes owned either partially or wholly by employees through a trust. And, there's a whole process you go through to establish an ESOP, but really the motivation behind this is, to preserve independence, reward the employees so that they actually get ownership in the business, and then create this like long-term succession plan. So a lot of times ESOPs get created when the owner's still pretty involved, but like it's like a similar to management buyout, like a gradual kind of an exit. Now, trust these, they're like there's a whole like legal and kind of like financial and accounting type of setup that needs to happen for ESOPs to make sense. And so there's a bit of administrative overhead, but a lot of companies kind of have used this as a retention tool and like a way to preserve that culture as well. And maybe we could kind of get into maybe like how would an ESOP kind of work from the owner slash seller's perspective?
Yeah. So technically speaking, it's the a trust that gets created that buys out the owner's shares, and then all of the employees, get shares to the trust. I think that could be financed initially through some bank debt, or the trust has debt to buy the shares from the owner, and then there could be a combination of a seller note that can pay back the owner over a long period of time. But it's kind of a longer term payout cycle. And to your point earlier, oftentimes people choose this because they value the employee retention. It's about the culture. It's about getting to a point where the whole team and all the people at the company actually own the company, a share of the company, not just one individual kind of owning all the shares.
Yeah, I don't know too many of these like in the agency space, but I do remember there's an IT company at the owner, and they had an ESOP situation, which was cool. And like I think they there was a big I think draw for kind of, and they're a huge, many thousands of people firm. But I think the ESOP part was like almost like a recruiting point as well for folks who want to kind of enter a culture that's been well preserved, and there's this kind of upside. And I think from the employee's perspective, now they have shares in this company, which, can appreciate in value as the company grows. And then, I think when the employee leaves, then the company has to buy back those shares. So then they can recognize that appreciation then. So I think that's kind of the benefit to offering something like this.
Again, this is all about founders who value their legacy, making sure the company kind of stays on and lives on beyond them. And in most cases, this is not about like getting the biggest price for your business. It's kind of weighing some of these other factors.
Yeah, definitely.
Yeah.
Although, there are cases where the ESOP can go public or like have a buyout as well. So, nothing is forever.
Yeah.
Yeah.
Yeah. Yes.
Okay. Well, kind of switching gears. So, I think we talked a lot about these six buyer types, and I think it may be helpful to kind of reiterate, where does Barrel Holdings fit in? We talked about the independent HoldCo as kind of our model, but maybe we can kind of run down, maybe our philosophy and how we might be different from these other buyers.
Yeah. So we are definitely in that independent HoldCo permanent capital category, but we're really looking for long-term ownership of these businesses without any specific, exit timeline. However, if there are opportunities to sell agencies, if there's an opportunity comes up that it's too good to pass up or it's really a good time, we may, have, the option to sell an agency. Another thing that we really focus on is decentralized operations. So each agency retaining its own brand, its own team, its own autonomy. Essentially, we want each business to run on its own, make their decisions, and really we help with goal setting and be advisors to them, but ultimately they make their own decisions day to day. The next area is having our shared set of playbooks and systems that we kind of standardize. So what we see from one agency to the next, can we, take some learnings and share with everybody so that everyone is doing everything in the best way possible. And also, there's some ways that when we're looking at the financials, we're looking at apples to apples, so people aren't reporting things differently. The fourth point here is just thinking about compounding growth over time. And each agency that kind of comes in, it's all about how they can execute better themselves, how we can use these playbook systems and how we can support them versus any like cross sell, like forcing them to co-pitch on things. Like we're not trying to get value from that. More so each business should be kind of successful and create value on their own.
Yeah, and I think this is like a specific POV that we developed. And I think, in the space and the size of agencies we play with, we do think there's like, agencies, there's like a fragile but valuable kind of secret sauce with the culture that like if you want to get true value, it's best to try to preserve that as much as possible. And this is why like we do like the idea of like, okay, like let's, we identify an agency and kind of see value its culture and kind of think that, okay, this is something that we want in our portfolio. We want to kind of protect it and like not kind of try to switch things up and make them do something that, they're that's completely antithetical to what's made them successful. So I think that is a key distinction for us.
Yeah. The point earlier is, we don't have any timelines. Like we're not a private equity fund, so we don't have to exit on any specific timeline. But at the same time, we're looking at opportunities to help each individual business. So if there are any tuck-in or bolt-on opportunities per agency, we'll look at that as ways to acquire more businesses that will help each business scale, but not necessarily like combining or forcing any of that synergy.
Yeah. So this is an important point because we kind of tout the decentralized operations, but then, for some of these acquisitions, which fall on the smaller side, there's going to be integration. The brand will most likely go away and then kind of be absorbed by the larger agency. So we do play a little bit more in kind of similar to what a strategic might in terms of the integration aspect of it. Except we're trying, with capital discipline, we're trying to avoid paying too much of a premium for these agencies.
Yeah. And for us, what we look for is we try to get cash flow from these agencies. So having sustainable cash flow is really important so that we can use the cash to then reinvest to decide to acquire more businesses, either standalone or tuck in, or invest further in the existing businesses.
Yeah. So maybe just to sum it up, I think I could kind of walk through, what are we actually looking for in the agencies that we acquire? Just at a high level, we do kind of for standalone agencies we bring into the portfolio, we're looking typically at like 800K to 1.5 million in EBITDA. And that, usually translates to like, 4 to as much as 10 million in revenue. I think like we typically look at what like anywhere between 3 to 5x is probably where we play in terms of
Yeah.
EBITDA multiples. For tuck-ins, probably any business that's sub 2 million that for whatever reason could be a good fit within one of our existing agencies. And so that's kind of where we do it. And then just some characteristics that I think is common among any acquirers, but I think it's worth continuing to share is like, strong margins. We like recurring revenue. Clear positioning is always important. Obviously, like, operators who can operate autonomously, but can welcome, someone like us who can help provide some guidance and accountability. And then we talked about the culture is super valuable. And one way we think about a strong culture is one that, embraces a growth mindset and is really intent on serving clients and, deepening the relationships with clients. Because at the end, this is about services, and we really kind of value a culture that, prides itself on deepening relationships.
All right. Yeah. To close things out, when agency owners think about selling, usually the focus is on what's the price, what's the timing, how long do I need to be involved, and how long is this going to take. But really, as we've illustrated today, there's so many different types of buyers. So it's understanding what kind of buyer do you want to build a future with. And each buyer, as we've shared, has a different philosophy on like how they're scaling, when they want to exit, do they want to keep the business? And at Bear Holdings, we focus obviously on thinking about the long term. And I think, yeah, it's definitely important for if you're in the position to sell your agency, thinking about what you want for the future. Because yeah, there is no right or wrong answer. It's what it matters for you personally.
Yeah, awesome. We covered a lot of ground. So thank you all for tuning in, and we'll see you next time.
Thanks.